Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome to this special episode of Options Insider Radio, live from Vegas. As many of you know, 2008 marks the 35th anniversary of the options market. And the options industry decided to celebrate this milestone in grand style by holding their annual conference in Las Vegas. So we thought we'd take our monthly show on the road to Las Vegas, grab as many interesting people as we could find at the conference, and sit them down in front of a microphone for a little impromptu chat. We were lucky enough to find quite a few volunteers, so over the next few weeks we're going to roll out a series of these live from Vegas episodes. So without further ado, let's get started.
Options Insider Radio.
Vegas expert interview.
Our next guest is Adam Nunes, the head of NASDAQ options market. Adam, welcome to the first of what I hope are going to be many appearances on our program down the road.
Well, me too. Thanks for having me.
You're welcome. You're welcome. Now, you just got your first month under your belt, so you're still relatively new to all of this. Tell our listeners a little bit about how your first month went.
Well, the first month went pretty well from our perspective. The first thing that we were concerned about or making sure was that the technology worked,
Yes.
that we were able to come into the market seamlessly. And so far, so good on that front. You know, the clearing's gone well, the matching has been up. We've been pretty upfront that we were equity-centric guys applying an equity system, and you know, there are a number of things that we had to get right that are different between options and equities, and I'm really proud of our technologists with the work they did to really get it up and running in a pretty seamless way.
No kinks, no crazy gremlins in the system so far?
Yeah, I can't say that there were no kinks, and I'm pretty sure there's something in the system that our technologists call a gremlin. But for the most part, when we found things, they were minor. We were able to clean them up really easily, and certainly nothing disruptive. So that's been really good.
It's good to hear. I know you guys were in testing for like 3 to 6 months before you launched, so that probably cleaned up a lot of that stuff.
It helps. I think we would have preferred to have 3 months instead of 6 of testing, but
true.
It is what it is.
SEC had something to do with that, I'd imagine.
We spoke last month at the FIA conference down in Boca. At the time, you mentioned that your plan was to have about 22 names listed a few weeks after launch. How's that going? You have all 22 up there? Or?
The rollout that we went through, we started with 2. We added another, I think, 19 the week after that. So right now we're up to just under 100 underlyings. We've got about 2,500 symbols trading, and the goal we have right now is that by the end of May, we should be in right around 200. Really, at this point, we know the technology works. We know it can handle the volume. And it's just a matter of getting our liquidity providers ready to go and getting product out there.
It's a rather unique experience, I think, launching a new options exchange. Now that the launch is finally behind you, what did you learn maybe you weren't planning on doing up until the actual moment when you launched?
Well, for the most part, things went as we expected. There were a few things I learned just from starting a new product and starting at zero. What we found as far as I referred to the technology, that all worked. What we found just on the day-to-day operation of the system, what we found is it's been inconsistent as far as the liquidity we've had. And what we found over the month is early on as we were rolling out, you'd have one firm disconnects and you really notice it in a way that clearly on the equities market we wouldn't. But that's really worked itself out. So at this point, I think we're more consistent. We're quoting aggressively, which I've been really pleased with. And yesterday, we were over 100,000 contracts. We were over 100,000 today. And the market share in the past couple of weeks has been between 0.6 of a point and just under a point. So
impressive for the first few weeks.
Yeah, we've been pretty happy with the growth. And we need to get out there, get in front of our customers, get more people connected and more people trading. So that's what we're focused on.
Now you mentioned you're quoting aggressively. Do you have any NBBO numbers?
We're really waiting for the consistency to be there and frankly to add more products.
More names.
It's just we're in such a small, there are hundreds of thousands of products out there. We're in 2,500.
Yeah.
So we know we have a long way to go there. We don't really plan to be in everything, but we plan to be in the active options.
Names. Yes. Yeah. Now, obviously, the crux of your exchange is price improvement, but a faster price improvement than what they have over at the box. I believe you were saying it's in microseconds if someone's already in the NASDAQ system. How is that going so far? What percentage of your orders are actually receiving price improvement?
Right. That, for me, is a work in progress. The response time of the system, and it doesn't matter from our perspective whether it's matched at a nickel or dime or a penny. The response time on the system is sub-millisecond.
Okay.
And for price improvement, that's really been where we really need to build more consistency. We have some every day. We had one day where actually 2/3 of the trades we had in nickel and dime names were improved. The next day, that dropped down to a couple percent. So that's been pretty inconsistent. plan we have is to just work with our liquidity providers, get the consistency there, and once the consistency's there, to really get that story out, but that's a work in progress for us.
Another goal of your exchange has been to migrate some of your traditional equity customers at NASDAQ over into the options fold. It's only been a few weeks, so it's kind of hard to measure, but how is that progressing so far? A lot of interest?
The interest is certainly high. Really, the story starts back a few years ago when we acquired INET. We were going around and talking to the major INET users, and we heard from a few of them, we want INET for options. And that's a few years later what we delivered. What we found on that is that some of the firms got into options before we did, generally just by a few months, and they're here, and they're using the system. And we have several others who are 2 to 3 to 6 months behind us. But the response has been good, and it's really an asset class that they're looking at. They see the growth. They see what everyone else is seeing there.
Now, obviously, there are a lot of parallels to be made between your exchange and the box. You're both designed fundamentally around price improvement. Both came to market with an innovation on price improvement. Box was one of the first, and it worked so well, they were quickly copied by everyone else. If your fast price improvement system becomes popular when everyone else jumps in and copies you and files for their own approval for that same process, what other things do you have down the road to really make you guys stand out?
Well, I think fundamentally I look at the market in the penny names to differentiate us and then the non-penny names. So in the non-penny names, or I shouldn't say names, but in the non-penny strikes or whatever it is. So in those, that's where price improvement really comes in. To the extent that we're successful, which I think we will be, and we're copied, and there's a great deal of price improvement going on, to me, that's really telling everyone, it seems like things should be quoted in pennies. If they're consistently trading there, then let's add transparency to the market and bring them into the penny fold. That kind of goes back to, for those penny names, that's where I think that our speed and our technology can really differentiate us. And when you look at a sub-millisecond response time versus 20 or 30 or 50, that really factors into a firm's risk management. You've determined you want to change your price and you're not willing to trade at $1 anymore, you want to be at $2. Mm-hmm. You don't want that trade once you've made that determination. So the faster you're able to get your price out of the way, the better you're able to manage your risk. And what we find, certainly in the equities world and what we're working towards in the options world, is that the liquidity providers we have understand that. And the better they are at managing their risk, the more aggressively they can quote.
Yes.
And whether we win the trade or someone else does, that's making tighter markets, and that's going to be good for everyone.
It's actually an interesting comment because it's similar to what Scott Morris said earlier about the box. He said he thought the two of you should actually unite against the other payment exchanges out there. And I think his quote was, if the communists and the Westerners can unite against the Allies, then you two should be able to see eye to eye on that. So I thought that was pretty humorous. But you mentioned pennies earlier, and obviously this morning there was a bit of a disagreement on that exchange leader panel about the true impact of pennies. And you're obviously a proponent of pennies. Your exchange is designed around it. We had Mike Bickford from the Amex on this show last month. He obviously is a little more concerned about the impact of pennies. He's obviously not the only one. The CBOA others are out there. What do you think about the concerns of the impact on institutional order flow and fragmentation of liquidity and all these other concerns that people have, that it could be actually hurting the market as opposed to helping?
Well, they're valid concerns. And I think neither Scott nor I nor Ed Boyle from NYSE want to see the institutional market hurt. I know that from my perspective, I believe that the exchanges and the brokers can provide better tools to provide the ability for institutional firms to trade and to find size in a penny market. And I think there's some empirical evidence from what happened in equities. So everything went to pennies in equities. And frankly, for a year or two, the market was difficult for institutional investors. What you then saw was innovation from the exchanges, the ECNs, as well as the broker-dealers to bring things like reserve, discretion, algos, better smart routers, to bring them to bear to solve the problem.
Yes.
So seeing the options market go to pennies in a more controlled manner, I think makes sense because it provides more time for those to come to market and to help to solve those problems. There are some further things as far as in the decentralized linkage, there's the concept of a benchmark trade, and that can open up the ability to do a VWAP type trade, and Archangel is out there with their GWAP product. That brings new tools that allow institutions to get size done. It brings it into the exchange fold, which I think is a good thing. And Eric Siri in his speech just talked about if your response to the current market is to just keep doing what you had been doing before, that's the wrong response. Everyone's going to need to adapt, but I don't believe that this is a necessary bad. Clearly size is down at the inside. That doesn't mean it's disappeared. It means we need to find new ways to provide liquidity and to access liquidity.
Coming up after the break.
Whether that fragmentation from those dark pools would confuse retail customers and maybe end up driving them out of the market.
When we return with Mark Longo and Adam Nunes, live in Las Vegas on Options Insider Radio. Go inside the options markets with theoptionsinsider.com, where you'll find the latest industry headlines, articles from options professionals, and a discussion center where you can ask questions on a wide variety of options topics. You'll even find an audio program called Options Insider Radio that examines the hottest topics from the world of options. Best of all, there is no charge for anything on theoptionsinsider.com. Visit theoptionsinsider.com today and go inside the world of options. Options Insider Radio.
Vegas expert interview continues.
You know, it's funny you should mention 3D Markets and their Archangel platform and now the Ballista platform. These platforms are getting a lot of interest these days, and there also seems to be a fair amount of disagreement about whether they are actually beneficial or not. You obviously seem to think they are, and the other side of the coin, concerns about how they're just adding another layer of fragmentation and maybe removing a layer of transparency from the market. Obviously, you heard this morning when I think it was Tony McCormick from Schwab, he raised that question about whether that fragmentation from those dark pools would confuse retail customers and maybe end up driving them out of the market. So there is a lot of consternation out there about these dark pools and whether they're actually additive or not.
Well, clearly the trick is to marry the institutional and the retail markets into something that's rational, to where you're not going to disenfranchise one in favor of the other. And frankly, the institutional market is generally reflecting the retail market, just pooling the assets. So I harp on it, but again, you look back at the equities world, and that just hasn't been the experience. They're certainly there. And whether it's NASDAQ's penny prices, you know what, somehow I have a hard time believing that if a retail investor sees a 105 offer and goes to lift it and gets 103 back, that they're going to be upset about that. They just saved 2 cents. So
I think he was more worried about like maybe trade throughs.
From a regulatory standpoint, there's a balance to strike there. So I think that what we have in decentralized linkage is a benchmark exemption. And kind of following on from Reg NMS, if you properly mark those and just say, this was a benchmark trade, it didn't have anything to do with the NBBO at the time it was printed, then you provide the right information. If that retail investor calls and says, you know, I saw this trade go up at some weird price that didn't seem like it had anything to do with anything, and I was at the inside bid, you can say, oh, that trade was marked benchmark. It could have been a VWAP type trade or something to that effect. And I think investors have kind of seen that and understand that enough.
Yeah, the retail investor is becoming a lot more experienced these days. We see that on our site quite a bit. I think the definition of retail investor has become a lot different in the last few years than it was just 5 years ago. Speaking of disagreement, there also was a lot of disagreement this morning over the whole SEC CFTC debate. The ISC and CBOE seem to have taken very different sides of that opinion this morning, and I'm curious where NASDAQ falls on that very fractious issue.
Well, from our perspective, how it happens isn't necessarily the most important part. It's really what the regulatory framework evolves to. And clearly, our concern is a competitive concern. And we look at the futures exchanges, and they self-certify their rule filings, and they're ready to go the next day. You look, foreign regulators, and they can do the same thing, where we're hung up, depending on what the filing is, either for really a short period of time or for a much longer time going through the process. So you hear a lot about rules-based versus principles-based. I think really an important first step would be using a tool that already exists. The SEC has what they call the B3A process, which is how you get a rule filing to be immediately effective. Okay. Right now, that process applies to pricing changes. It applies to changes where you're effectively duplicating something that another exchange already has. But it doesn't apply to changes that aren't necessarily controversial, aren't major market structure changes, but a new order type. And a new order type can take you months to bring to market. And where we have been on the equity side is the exchanges have been subject to that, whereas ECNs haven't. So it's been a competitive issue there. Yes. So from my perspective, a really easy first step is to make more use of the immediate effective process. And through that process, the SEC still has a tool to make sure that an exchange isn't bringing something to market that they might deem harmful. They can actually step in after you've filed and say, you can't do that. It's called abrogation, which is basically going in and saying that rule filing's been abrogated. You either need to file it and put it out for comment or revise it. And that's still a pretty powerful tool that they have. So it's not no regulation versus regulation. It's really the process. And we certainly think the process can be improved.
Now, obviously, you have embraced maker-taker at your exchange. Box has done so recently as well. NYSE Arca also a maker-taker exchange. Obviously, maker taker is gaining a lot of steam. I'm curious what you think. If this is the extent of it for now, just you three exchanges, or I think as it starts to gain market share, other exchanges are going to start diving into that as well?
Well, I think that to answer that, I have to just go to the Philly acquisition.
Okay.
And our view on that is clearly there are two models that are evolving, and we expect those two models to coexist for some time. So what we're looking at there is NASDAQ will be in the maker-taker model. Philly will maintain what I'd refer to as the traditional model, and that'll allow us to really serve those customer sets.
Okay.
Now, you've seen Nasiarka and Amex.
Same thing. Yeah.
And they seem like they're doing the same thing. So the tricky part is going to be for those that if you have a single model, you have to go one way or the other, whereas we're positioned to provide both and try to be the best at both. So thankfully for us, that's not a problem we have. It's going to be interesting to see how the other exchanges, compete. It seems like they have to go in one direction or the other. But certainly for the next several years, we see that being the case. And it really just goes to the customers we're serving. So long as, it's difficult to come up with a single model that's going to make everyone happy, then we're going to have two and try to serve the different niches. And niche may not be the right term because they're rather large niches. So if you look at where the market is right now, you've got, frankly, 80% is in the traditional model. Call it 20s in the maker-taker model. We came out with the NASDAQ options market because we saw that percent that was in the maker-taker growing, really driven by pennies. I don't have the crystal ball to say whether it goes from 80-20 to 60-40 or 70-30 or 30-70. We're in a position where we care less than we would if we just had the single model, but we fundamentally don't know the answer to it. And it's going to be driven by where the market goes and what type of business grows the overall pie, which everyone can get behind growing the pie.
Now, we touched on market share before. I was curious, you have some end-of-year goal for whether it's penny names or overall market share.
We don't have a stated goal. From my perspective, what's important to me is really the bottom line of the business. And it was referred to on the CEO panel that there's not a pool of money that gets divided up by market share. It's really contract volume driven. So those are the targets that we're interested in hitting, and we're focused on going out and earning it. We know our technology needs to be good. We need to do a better job delivering price improvement and keep the system stable, and then just get out there in front of our customers and listen and do smart things.
That's about all I have for you today, Adam, unless there's something that you'd like to add.
Thanks for having me on.
No problem. I'm glad we can finally get you on. I know we've wanted to have you on for a while. I hope this is the first of many appearances down the road as NASDAQ grows. You can come back and we'll talk about all the new developments.
Very good. Thanks, Mark.
And that's going to do it for my conversation with Adam Nunes, the head of the NASDAQ options market. Be sure to stay tuned to www.theoptionsinsider.com for more of my interviews from the Options Industry Conference in Las Vegas. While you're there, be sure to register for our discussion center and sign up for our monthly email newsletter. If you're one of the growing number of Twitter fans out there, then be sure to follow us at twitter.com/options. And you can have links to selected content and headlines from our website delivered directly to your cell phone or wherever you get your Twitter alerts. Thanks again for listening. My name is Mark Longo, and I'll see you next time on Options Insider Radio.
Options Insider Radio was created by Mark Longo and produced by Gene Crotty. Engineering and sound design by Jeff Sounds Productions, www.jeffsounds.com. Options Insider Radio is a production of the Options Insider Incorporated. All rights reserved.